Basically, we were looking at hedging of different interest rate risk exposures using financial futures. And depending on the interest rate scenario and also your position, or your position means your risk perspective, you have to either go for a long or short hedge in the futures market. Okay. So let me go to the next area. Before I move to the next area, are there anything you need to clarify? Okay. So let's, now what you saw was, now even this example which I explained, it will not completely eliminate the, loss, but it will reduce the risk. Now, for example, if they didn't have this futures hedging, that is selling a future contract in the euro dollars, the bank would end up with a cost of 2,500 if we didn't have. But because of this future, bank able to reduce the loss to 1,775. So this is a part of risk mitigation, risk reduction, but it may not completely reduce the risk. I mean, it may not be zero. So what is the reason? What do you see the reason? Even this example you can see. What could be the reason? Anyone think of any reason? No?
Due to the change in maturity patterns and the yield patterns. So due to the changes in the yield patterns and maturity patterns, so we can't exactly match the derivatives or the options. Therefore, like we can hedge and minimize the losses, but exactly we can't match the expectations. That means the revenues and the losses.
Okay, can you all see the presentation?
Yes, sir.
Yes, sir.
Sorry, I think there's a connection, a loss of connection. I didn't see. Okay, so let's, did you, this part, did you hear this part, micro hedging and macro hedging? Were you able to pick what I said in the micro and macro hedging?
No, sir. We have, please repeat.
Okay, previous slide, basis.
No, sir. It was disconnected from the change in the basis. From the inception onwards, it's disconnected.
This one I think we discussed. This one we discussed, I think. Right?
In the midst, halfway through this has disconnected. Will you be
Okay.
able to speak?
No, basically what we were explaining was that if you want to hedge your position, you cannot completely, eliminate the risk because of the movement of future interest rates and the cash market interest rate are not the same. You see, in previous example, when the cash market interest rate changes by 1%, future market interest rate change only by 0.29%. So the net difference is 0.71%, positive 0.71%. That means that risk we have to take, right? So if you find an instrument in a market where the futures market interest rate change is also same as the cash market interest rate change, you are fully covered. Okay, you are fully covered. But the idea is to at least partially cover yourself, right? So in the previous example, if you did not have any sort of a hedge, you would have ended up with a net interest income loss of $2,500. But it reduced to 1,700 something, right? So that is the objective. Okay. So let's move on to the next part, the micro hedging and macro hedging. Okay. So what is micro hedging? What is macro hedging? Now, when you take your balance sheet, there are a number of elements, assets as well as liabilities and also commitment. Now, if you want to hedge a risk arising from a particular instrument in your balance sheet, you can do so. Let's say, now remember last week we did an example of the bank issuing a 5-year deposit product. Then we worked out to cover up the risk of interest rate movements, what products available. Now we looked at zero coupon bond and we looked at a 6-year maturity, 8% coupon bond. So to hedge again particular instrument interest rate risk, you can use a specific, hedging instrument. So that is called micro hedging. So you only focus a particular instrument as and when you feel you want to hedge. I mean, that all depends on how do you perceive the risk. Now, alternatively, the bank may think of looking at a broader macro perspective, right? The portfolio. Now, let's say loan portfolio, debenture portfolio, or even going beyond that and the entire balance sheet. So there, what you try to do is not to look at individual instrument. You look at the entire balance sheet, risk exposure arising from the trading portfolios, and then hedge against that particular risk. So that is called the macro hedging. That all depends on how do you perceive the risk, right? How do you perceive up to what level now? Now, hedging is not free. Hedging is also at a cost, and you have to deploy resources. So that's why, if you go to the very first principle of the risk management, what is the one of the we looked at several components of risk management, of which one is, once you identify the risk, so what is the next element? Basic principles. I mean, it's not just for interest rate risk, but for overall risk management. What is the next step once you identify the risk in your bank or firm? Can you all hear?
To mitigate the risk, take steps to mitigate the risk.
Yeah, but before mitigating?
identifying the reason. So
Measurement.
All this fine, but one thing we looked at, remember, after this assessment, this next step. Huh?
Analyze and assess the risk. Assess the risk.
Okay, then what? There's a specific thing we need to look at. To analyze, assess, and what we do. So you have 1,000 risk items, you identified, analyze everything. Then what you do?
classify the risk according to the weightage.
Sorry, to?
Classify the risk according to the weightage matrix formation.
Yeah, okay, risk matrix. So risk matrix, what we do is risk prioritization. Remember, after risk identification, assessment, all these, you have to prioritize risk. So you have to put them into a risk grid, risk matrix. One side you have impact, one side you have the likelihood. So likelihood, and so basically once you identify the risk, you prioritize risk based on the likelihood and impact. So what is the purpose of doing that? Is to identify the most important risk that you need to mitigate. So risk prioritization, you are not going to mitigate each and every risk. There are 4 ways to look at a particular risk. So what are the 4 ways? You can avoid the risk. You can accept the risk. You can manage or mitigate the risk. You can transfer the risk. Risk sharing. So accept, avoid, mitigate, sharing. So those are the basic 4 things you do once you identify the risk and prioritize. Right? So similarly, all these micro hedging, macro hedging depend on, because all these involve resources. So in a bank, you may come across 1,000 odd risks, but on different aspects, credit, market, liquidity, operation. So you can't manage, or you can't deploy resources for manage each and every risk. Remember? So that's why it is important to manage risks which are important through the risk prioritization metrics. Okay. So that's why I said whether it's a micro hedging you look for, macro hedging depend on how do you perceive the risk in your balance sheet and your policy. This may be different from one bank to another bank, you know. So that's like a, now person having 2 cars. One is usually kept in the garage, hardly used for anything, but other one you use for daily activities, maybe going to office and all those stuff. But now let's say the one car is worth about maybe 10 million, another car is worth about, let's say, 20 million. Now the car which is not using very much worth 20 million. But most of the time, it's parked in the garage, you use very rarely. So now you can mitigate the risk of both cars by insurance. Now, if you want to insure 20 million car, you have to pay a big amount, but then 10 million car. So you can, it's not free. To insure, you have to insure to the right value and it's not free. But now it's up to you to take a decision. Now, let's say my insurance premium is, let's say, 500,000 per annum on this car. So I have to take a call. Now, I am not using it. Now, 20 million one, I am not using it, for what you call many transactions, or maybe moving for anything. So I have to take a call. I mean, whether this is, I need to put 500,000 rupees for insuring this vehicle, right? Or I just accept the risk. So probably wherever I go, I know where I don't go, at busy times, maybe at bad roads, or I may not park at isolated locations. So probably I will take other precautionary measures and save that 500,000. Because probability and all this happening is very small. So why should I waste 500,000 for a car parked in garage over almost 360 days of the year? I have hardly used that car. So that is your policy. I mean, if you are fine, if you can deploy resources, okay, you will let you insure that as well. So that's up to you. So either you take in a bank's perspective, you look at the individual elements where you see probable risk arising from those assets or liabilities, you use micro hedging, or you just don't look at individual, you take a holistic view about portfolio or in the balance, even the balance sheet. So that's micro and macro hedging. That's up to you. So let's look at now, how do we look at futures market instruments to micro hedge? So these are very popular micro hedging or the hedging instrument. So determine the bank interest rate question. Now, bank has to determine the interest rate question. Forecast dollar flows or expected or value expected in cash transaction. So look at the interest rate position. Look, forecast now. This is futuristic, right? Then forecast the flows or expected value in the future in the cash market. So now the risk is the opposite taking place, that your cash flows will be affected due to interest rate changes that you don't realize. So now select the appropriate futures contract. Okay, now, for example, can someone give example? Now you are planning to now you have a currently you have a I'll take a government security. Now you are in the trading portfolio. You have a holding a government security, government bond. Okay. You have government bond, current maturing in, let's say, 5 years time, but you are not using at investment portfolio, you are trading it. So within this 5 year, anytime you can exit the market because you are a trader. Okay, so your plan is now you want to invest in another instrument and you want to realize the cash flows in 3 months time through this particular sale of particular bond. Okay, so what is the risk to you? So you are holding a position. You are long on a physical asset, physical financial asset in the sense here the bond. Physically mean you are not physically holding, but it's in the balance sheet. So you are holding a treasury bond maturing in 5 years time from today, but your intention is to sell it in 3 months time in the market. Okay, in the market. So what is the risk to you? Current interest rate yields are, let's say, around 8%. So what is the risk to you? Now you are going to do a micro hedging. So what is the risk to you?
Drop on the price of the bond.
Sorry?
There will be a drop in the price, bond price, because of the interest is going up.
Yeah, okay. The risk is possible interest rate increase. Possible interest rate increase in the market at the time of you are selling the bond. That is 3 months time. If the market interest rate moves up, price will drop. So let's say today price is on a par value of 100. Today it is trading at, let's say, 92 on a par value of 100, right? So if the interest rate rise, let's say it comes down to 88 per 100, okay, 100 par value. So that means par value of 100, one instrument, it dropped by 4 rupees. So that means if you want to, if that happens, in 3 months time, definitely you will realize only 88. If you sell it today, you will realize 92. But if you hold it and want to sell it 3 months time, interest rate rise, then it will drop to 88 and you will end up with a loss. Probably that may not be enough for your other transaction. So that is the risk. So how you can mitigate that? So basically your currency flows will be affected. Your currency flows will be affected. What you can do in futures market? Can someone tell? What you can do? Now you are the risk manager. You have to take a decision.
Yeah, for short-term hedging.
Yeah. Can you elaborate a little bit? Short, what? How you can do it? You are correct to some extent, but if you elaborate a little bit, how do you do it?
According to the underlying assets, we can decide the contract for which is expiring on 3 months' time. According to that, we can hedge our underlying assets with the hedging contract.
Yeah, but what is important in hedging? How do you do it? First part, what you said. First few words you mentioned in the answer. Hedging means you can hedge in many ways. So here what you are doing.
We can select what is our actual period of the
Now all this
expiry.
fine. But what you have to do? All this fine, but and you can hedge many ways. So you
Short term.
Yeah, you have to short a contract. Exactly. You have to short a contract, right? You have a position right now in your balance sheet. So your risk is interest rate rising, value drops. Okay. Then you short a contract. Short a futures contract. You have to find in the market a short contract, futures contract, which meets your requirement. Now, let's say you are going to cover up a portfolio of, in this bond portfolio, 10,000 rupees. So you have to find out for contract now. Now, if you look at euro dollar futures, those are 1 million contract. So if it's a $10 million one, you have to find 10 contracts. Okay, euro dollars. So then you have to identify how many contracts you are going to use, and you have to find out, because now these futures are standardized, so you cannot hedge the maturity of these the futures are not the same as maturity you are expecting, not the maturity, the trading date. So much closer date contract to your requirement, then you have to short. Okay, so when you short, what happens if the interest rate rise? What will happen to the futures contract price? Now, cash market, what happened? We discussed earlier. If the interest rate rise, price will, what happened? Few minutes ago you told the risk is this.
For the cash market, when the price rise, it auto that
Price
rates will
rise,
be also
price,
rise.
interest rate rise, price rise,
The interest rate rise, prices will go down.
then futures market.
Future market, we have hedges for the particular rate, price. Then it will be stick on to that price for that particular period.
Yeah, but what I'm asking is that equal to the futures price. What happened to the futures price when the interest rate, because the cash market interest rate rise, future market interest rate will also rise. Okay, then what would be the futures price? Anyone?
That will also rise.
That will also rise. Rise? interest rate rise, price, what happened?
Price will
Price
go
drop.
down.
Price drop. I mean, when the interest rate rise, whether it's cash market or futures market, price drops, no? In a fixed income security. Doesn't matter. But in the cash market, you don't have any control because you have to, if you want to sell at that date, you have to sell. No question of it. If you want to sell, then there is a loss of cash flow in the cash market. Then futures market, what happened? Because you have already agreed today the selling price. That means the futures contract value. So then you can sell it at the agreed price, but when the price drops, you can settle it by buying in the market at a lower price. Shorting. Short means that. So when you short it, you can still realize the higher price in the futures market on whatever the future date. But in the cash market, price drops. So you set off the loss of cash flow in the cash market with a gain in the cash flow in the futures market. So if the change is equal in the interest rate in the both futures and cash market, you will end up with zero risk. But if it is not the same, you will partially cover your exposure, right? Clear? So that's basically micro hedging a particular financial instrument. Now let's move on to the macro hedging. Micro hedging, how many contracts you want to buy. These are the numbers you can work out. The number of contracts depending on your position. You can decide the number of contracts. Now number of contracts equal the dollar value of cash flow to be hedged. Dollar value of cash flow to be hedged. F means futures value of the futures contract, face value. Okay, futures also trading at a price and based on a face value. Then MC is the maturity or duration of anticipated cash asset or liability. Okay. Then MF, maturity or duration of futures contract. Okay. So then P equal expected rate movement on cash instrument divided by expected rate movement futures contract. So using this formula, you can identify how many contracts I should buy or sell to, depending on my risk exposure, to be bought or sold to cover up my risk, right? Okay. So determine mechanics of applying micro, determine the appropriate time frame for the hedge. So you have to determine and also monitor the hedge performance. Now even you can close the hedge, close the position before even maturity. When you get opportunity, you can close it before the date, because this is a standardized exchange traded instrument, right? But if you go for a forward contract with another party, then you cannot do that, because you have to wait till the agreement time to expire, right? Okay. Macro hedging, as I said, focuses on reducing interest rate risk associated with the bank's entire portfolio rather than with individual transactions. So it is more holistic view. You look at. So hedging, gap or earning sensitivity. If the gap is positive, the bank is asset sensitive and its net interest income rises when interest rate rises and falls when interest rate falls. So remember, so if there is a positive gap, use a long hedge. If there is a negative gap, use a short hedge, right? So positive gap, use a long hedge. If it's a negative gap, use a short hedge. Now In a positive gap, the risk is, now if you have a positive gap, what is the risk? Interest rate rise or decline. What is the risk? When you have a positive gap, what is the risk? I think all these things we have covered 2 weeks ago. Sorry, there was a connection lost again. Okay. So what happens when you have a positive gap? What is the risk to you? As a banker, what is the, as a risk manager, what is the risk when you have positive gap? What is the risk? What sort of interest rate movement you have put to risk? Can someone tell? All this thing we have covered in detail a few weeks ago. The repricing gap model is one of the commonly used model by any bank. A very basic, simple model to mitigate earnings risk. Even we looked at the C gap ratio, all those, remember C gap ratio? What is the C gap ratio? Can someone tell? Are you there or not? Because suddenly there may be disconnections also. Are you there or not? I think we need interaction, because I mean, I simply telling and going will not serve the purpose. You have to understand. When we look at repricing gap, can you hear me, please? because this breakage.
Yes, cumulative gap ratio is divided by the total assets.
Yeah. Okay, that's right.
So
Then
the positive gap in the gap means rate sensitive assets are higher,
yeah.
and therefore it will impact if there is a interest increases, then the net interest income will be affected.
Interest rate increase, it will have impact. I mean, I am at the risk because now impact will be there whether interest rate increase or decrease, but I mean, risk is that your income will get negatively affected. That is the risk. Yeah. If it positively move, you don't have any risk on the net interest income. You will end up with a better position. But what is the risk?
Match the liabilities according rate sensitive liabilities.
No, what is the risk? Risk means what is the overall risk to the bank when you have positive go? What sort of interest rate movement will have a risk to you? So this is a very basic thing. If people don't understand this, I mean, you can't do anything because these are the first principles. Remember, we discussed detail when the interest rate goes up, how expenditure affected, income affected, what is the impact on net interest. I remember I showed you a different chart, completely different chart when we're doing the repricing. I mean, without understand the principle, you don't know where to go. So if you want to go somewhere, you have to know whether I am going to gold, candy, or whatever. Without knowing where to go, you don't know how to go. So you have to understand the first principle. Then you have to select the right instrument. So these are important. And these are very basic things we learned how this interest rate movement affect, because your risk is you have to perceive the risk first. No, you have to perceive the possible risk. Based on that possible risk, only you take action. And based on the probability of that happening. So remember what is the important thing?
It
Risk
impacts the
prioritization.
revenue.
So what I'm
In
asking, very basic thing. If what
in
happens, you have a risk of losing in. If what happens in the interest rate market, very basic. That is the first thing. It will impact. Interest rate movement will impact your income, expenditure, everything. Whether it's increase, decrease, all these are impacted. But your risk is that you lose your income. If what happens, this will can create a risk to your bank, the earnings, net interest income.
It will reduce our bottom line and will impact on our equity.
in a positive gap scenario, if the interest rate rises, uh, if interest rate decrease, that will be a risk and it will reduce the car capital adequacy ratio. If there's a negative gap, then in interest rate rising scenario, that also will reduce the car capital adequacy ratio.
Okay. This is the other problem in Sri Lanka. Technology. You see. Can you see the presentation?
Yes, sir.
Okay. So what I am asking is a pretty simple thing. Okay. So what is the risk to you? Because you are a risk manager. Now you know your earnings position based on current. So what is the risk to you if you have a positive interest rate, rate sensitive gap? If you have positive rate sensitive gap, you are asset sensitive, right? So your asset sensitive means your assets are repriced at whatever, higher increase or decrease compared to the liabilities. That is the asset sensitive. Then the risk to you is the declining interest rates. That is the risk. Declining, if you have a positive gap, if the interest rate decline, you are at a risk. If the interest rate increase, your income will go up. So that is the thing. As a risk manager, you have to identify anything. What is the risk to you? Without knowing the risk to you, you can't hedge anything. Without knowing whether you want to go to candy or gold, how do you decide on the path? You identify, I want to go to candy. Then you decide, okay, this is the path. Or these are the alternatives. I want to go. Where? Candy, Jaffna, So that's the risk manager's job. And you have to see the likelihood of that happening, potential. I mean, you can't just because of the interest rate going, the theory is, okay, if you have a positive gap, declining interest rate will have adverse impact on your net interest income. That is the theory. Now you are the risk manager. You can't blindly go and hedge because why? What is the reason? Hedging. What is the reason? Again, I am asking the question.
Reduce the losses.
So why you can't just blindly go and hedge? What is the reason? And when you see a risk exposure, you can go and do hedging. No problem. But you don't do it. What is the reason? Again, I am asking. Prioritization. Because of you, the minor market interest rate can go up, come down. It can happen anytime. But because of that, we are not going to hedge everything. Because we need to prioritize. Prioritize based on what? Two things.
Likelihood and impact.
Likelihood and impact. So we have to determine, now say you have a positive interest rate gap. So what is the potential risk to you? What is the potential risk to you if you have positive interest rate gap? I want to move out for the next slide quickly because this is the last time. What is the potential risk to you if you have positive interest rate gap? Potential risk to you?
Declining
Decreasing
interest rate.
interest.
Decreasing interest rate. That is the potential loss to you, decreasing interest rate. Right? Then, now you identify the potential risk. Now, what is the second thing you have to do? Now, simply, okay, the interest rate, declining interest rate is risk to me. I will go and do a hedging. What you will do as a risk manager? What you will do?
Have to identify the proper hedging tactics. Which one we as a long-term hedging or short-term hedging or our amount and figures.
Okay, that's fine. Before that,
Impact and likelihood.
yeah, impact and life. So you have to see whether the interest rate will fall within next 3 months. What is the probability? Impact. Sorry, the likelihood. What is the likelihood? Now say all the indicators are in such a way that is not going to happen. That is not going to happen. Then You can simply accept the risk. So that is very usual. Other risk manager risk is not free. Okay, there's a cost. All depends on the probability of it's happening. Then use the right instrument. Okay, how did you determine? Okay, there's a probability of higher probability also. This happening, impact also happening. Now you decide whether you have to use a long or short hedge. So these are the very basic principles you have to understand. If you don't understand, you won't be a risk manager. So understand the principle. Now this, you can't memorize things. Now how this happened? Asset sensitive, interest rate decline, the declining income from your assets are higher than declining expenditure from your liabilities. That is the reason. Because you have positive gap. So the impact on declining income is much more than impact on declining. You get a benefit from both ends. Both ends. When the income decline, expenditure also decline. You get a benefit. Other side, but because okay, now take a scenario. Now, when you are a banker, now tomorrow you see the Federal Reserve of US has going to announce the Fed policy rates to be up. Fed policy rates to be going to go up, or in the future potential increase by the Federal Reserve. So what do you see foresee in such a case? What do you foresee? Huh? Bankers must know these things. These are general things, not big, magic or anything. If you are in the field for 10 years, these are basic things you should know. Bankers. So what do you foresee? Because these are what is happening in the markets, because we don't have any control in the financial market either in Sri Lanka or abroad. What is the risk for you foresee? Why I want to bring that example is to, look at the things from a broader perspective, not just, looking at the theory phase. You can't face the exam looking at theory because every question will be different. If you are given a scenario will be different. So Okay, sorry for disturbance. So you see now how efficient now Sri Lanka Telecom is. You can think, how efficient. Until now, you have to switch off to dialogue at a cost. You see, because I cannot use Zoom or other whatever platform. Here, it's just the data charge. So you see how efficient now Sri Lanka Telecom. Can you believe? Okay. Anyway, what I asked was now when you see tomorrow U.S. Federal Reserve going announce they are going to raise the interest rate, increase the interest rate, policy rate. So as bankers, what is the possible risk you see?
Borrowing rates will increase.
Here in Sri Lanka?
In the near future, there will be interest rate increase in the market.
I am referring to U.S. Federal Reserve announce. Okay, listen carefully. There is tomorrow the U.S. Federal Reserve announce they are going to increase the policy rate of USA. Okay, listen carefully. It's not Central Bank of Sri Lanka. U.S. Federal Reserve announced they are going to raise the policy interest rate in USA. Then what do you foresee potential risk or whatever impact on your banks? What areas?
Deposit rate deposit rate might be increased to attract more than their rates for the investors.
Okay. Yeah, okay, that can happen, but depending on how investors, foreign investors look at our deposit rates. But more than that, what is the,
It will directly impact on exchange rates.
sorry? I can't hear you properly. There's echo coming out.
Exchange rate, will be an exchange rate impact.
Can you speak a little loud, please? Because your voice is not, that high, loud. Exchange rate, you said something related, more related.
When they increase policy rates, the liquidity in that US market will drop, and that will increase the exchange rate. There will be exchange rate risk.
Exchange rate risk on what aspect? Can you link it?
The dollar gets stronger, and that will.
Dollar gets stronger. Yeah, dollar gets stronger. That means what for us? What is the risk?
On the trade side,
Rupee will depreciate.
I'm asking from your bank perspective. I'm asking
Rupee
as a
will
bank.
depreciate.
Huh?
Rupee will depreciate.
Yeah, rupee will depreciate. That means, rupee will naturally, there could be a possibility. So how it happens now? What happens is basically simple thing. Now the foreign investors have invested in Sri Lankan government securities, interest rate related bonds. Okay. So one possible impact I am referring to interest rate is that they may pull out initially, because when they see US rates are going to go up, definitely they may not hold this instrument here. So potentially, and also considering risk aspect, so they will withdraw their holdings here and they will move on to the US markets. So that will have an impact on our, demand for our, bonds. Okay, so that could have an impact also when there is a selling, price coming down, and when you sell it, naturally there's a more supply, then price should come down and yield can go up. Then on top of that, other thing is when the foreign currency is going to go out, then pressure on foreign currency. Okay, position, and resulting further depreciation can take place in the market, right? When there's a demand for US dollars to exit, that may have impact on foreign currency position, depending on what you have there, you see. So then you have to, when you see this information, you have to see how it's going to happen. So for example, if you have a shorter position, the depreciation of rupee against dollar will be negatively affected if you have a shorter position. Okay, so you have an oversold position, then you will be at a risk. So you have to look at how you can minimize the, what you call the open positions you have, right? So that is one element on your overall, I mean, it's not your bank alone, but overall banks impact on foreign exchange side. And also, I mean, that all depends on how much these people have invested. I mean, if it is a small amount, there won't be any impact. But if it is a big amount, and the changes in the US markets are in such a way that people will move to US market, then definitely it will have a significant impact. So all these factors, but from a risk perspective, what is important for you all to identify the risk? You see, identify the risk. So that is important, right? Okay, so as risk managers, you have to identify what is going to happen if this happens, and what is the probability. Then you have to take appropriate measures. So if you have positive gap, use a long hedge. If the interest rate falls, the bank's lower net interest income will be offset by the gains on futures position, because the impact is arising from the fall in interest rate. Okay, so you go for a long hedge. Then negative gap, you go for a short hedge. Okay, you go for a short hedge. If the rates rise, then bank's lower net interest income will be offset by gains in the futures position, interest rate rise. Okay. If the interest rate falls, then you don't have any problem. But if you hedge what happens, then you will end up with a positive gain in the interest, your book basis. But then that will be, you are at a loss on the futures position, but those will offset, right? So duration gap and okay, EVE, equity value, okay, sensitivity. To eliminate interest rate risk, the bank could structure its portfolio so that duration gap equals 0. Remember, that is what we learned. Okay, but that is practically difficult. But if you can do it, you are fine, right? So how do you do it? Change in equity value, okay, equal minus D gap. Remember, we learned duration gap when we use the duration formula, dA minus KDL times delta y divided by 1 plus 1. Now here y stands for yield into market value of assets. Okay, market value of assets. So this is the same formula we looked at when we looked at the duration, but here we need to use it for the hedging purpose, right? So futures can be used to adjust the bank's duration gap, and size of the futures position can be determined by solving the following equation for the market value of futures contract, where duration of futures is the duration of futures contract. DF is the duration of the futures contract. So duration of assets times market value of rate sensitive assets divided by 1 plus interest rate of overall balance sheet assets minus duration of liabilities, DL, duration of liabilities into market value of rate sensitive liabilities divided by 1 plus IL, overall rate sensitive liabilities interest, weighted average interest rate, plus duration of futures contracts times market value of futures contract divided by 1 plus interest rate of futures contract should be equal to 0. I mean, if you want to fully hedge, you can use the how many duration contracts you need to use, because if you compute this, then definitely you can identify the number of contracts, because you can compute the market value of futures contract. Okay. So just an example with a, for this one, duration of assets equal 2.88, duration of liabilities equal 1.61, the market value of assets equal 900, and market value of liabilities equal 920. Okay, the current weighted average interest rates of rate sensitive assets 1.1, and rate sensitive assets, rate sensitive liabilities current weighted average yield is 6%. So divided by 1.6 plus, let's say you have euro dollar futures having similar features, trading around with a duration of 0.25 years at 4.9%, then you can plug in 0.25 divided by 1.049 and the market value of the futures contract you need to hedge. Okay. Then you, based on the contract size, you can determine how many contracts you need to buy or sell. Now here, of course, how many contracts you need to sell to mitigate against interest rate risk. If you have a positive duration gap, market value of equity will decline if interest rate rise. Okay, if you have positive duration gap, market value will decline if interest rate rise. Okay, this is about duration gap, not the repricing gap. Then banks need to sell interest rate futures contracts in order to hedge its risk pressure. Okay. So when you sell, what happens? Short position means that you make a profit if futures rates increase. Okay, futures interest rate rise, your futures position will end up with a profit, right? Because your price will drop. You are shorting. So in the long position, you are making a loss. In the short position, you are making a gain. Okay. So this is again a small example. If interest rate increase by 1%, the profit on 4 futures contract, if you buy 4 futures contract of 100 face value, 4 into 100 into 25. Remember earlier we discussed one contract change is 25. So you end up with the $10,000 which partially offset your loss of 12,000. Okay. So we will work out a question later, giving a full, picture about the different interest rate, but just for your, knowledge how this can take place in a futures market. Okay. So let's move on to the macro hedging part. Macro hedging with futures on balance sheet. Remember, this is the formula we use without convexity adjustment. under the duration hedging. I think all of you can easily remember change in delta, change in equity equal minus DA minus K times DL. This is the duration gap times asset times change in interest rate divided by 1 plus R. So if you want to hedge using futures for the entire balance sheet, simply you have to match it with the futures contract change. So if there is a declining equity, you have to end up with a increase in futures value. So change in equity should be equal to the change in futures. So basically, how do you do it? You have to find number of futures contract you want to hedge using appropriate futures contract with the appropriate duration of futures contract. NF is the number of futures contract, PF is the price of the futures contract, multiplied by delta R divided by 1 plus R. So this is the extension of this formula for futures contract, so that when you lose from your equity side, you will end up with a gain on futures side. Right? So that immunize in such a way delta. But now in real practice, you can't make them zero because equal. Equal means your risk is zero, full hedge, 100% hedge, but which is not possible. So instead, you can see the impact of your equity as a result of change in interest rate, and then find impact on your futures price also, right? Okay, so let's move on to the forward contracts. Again, I think most of you are comfortable with forward contracts. All of you as risk managers engage in forward contracts in the market. Very common in our context as well. Okay, because we don't have standardized futures here in our local context, but forward contracts are very common. All of your banks have forward contracts. So what is the difference? Features wise, both are same. Futures as well as forwards are both same. Conceptually, it is same. Whatever the things you need to do for risk management in a futures market, you should have to do in the forward contract, depending on the scenario. No difference. If you want to sell futures contract to hedge against particular interest rate risk, you have to do the same thing in the forward contract. You have to sell forward contracts, right? Sell forward contracts. But what is the key difference? Principles are same. Some fundamental differences. I think I explained to you earlier also in the class. What is the fundamental difference? There are advantages, disadvantages. What are the advantages? And what are the disadvantages? Can someone tell? Anyone? Can someone tell advantage, someone tell disadvantage? Because forwards are also contracts where two parties agree to exchange a specified amount of a designated product or financial instrument at a specified price or rate on a specified future date. Same thing. Conceptually, this is what is happening in a futures contract, which is traded in an organized exchange. Can someone explain? Conceptually, the things what is happening is same. But what benefits and what disadvantage compared to the futures? Can someone tell?
In a forward contract,
Yeah.
in a forward contract, if the currency moves in your favor, then you will lose since you have already.
Forward contract.
In a forward contract, if the currency rate changes, like like since you have already booked the forward, if the currency rates come down, then you will be not benefiting from that.
Again, I think all depends on your position. Remember, as a risk manager, you have to identify what is the risk to you based on your position. Because of currency moves up or down, it will not always impact you. So you have to identify the position. Okay, that is related to the foreign exchange you mentioned. But in general, I am asking in general, what is the benefit of having a forward contract over a futures contract, or any disadvantage? I am not referring to any particular instrument, but in general. What benefits you have forward contracts over a futures contract, and what disadvantage? So we learn what is a futures contract. The conceptually, what is happening in a forward contract is same. What you expect from a risk perspective, same. What you do in a futures market, you do in the same thing in the forward market to manage your risk. There is no difference. But what benefits you have and what disadvantages you have in a
Futures are like standardized. Forwards can be customized according to our requirement.
There's an echo sound coming. If you could speak a little bit louder, can't hear you properly. Can you tell a little bit louder?
Forwards can be customized according to our requirement, but futures we cannot. There's a standard.
Yeah. Okay, so that is one thing. Yeah. When anything else? Okay. Now you remember. Now, when you say futures contract, if you look at euro-dollar futures, you have to go by the market, contract, because there is nothing you can suit to meet your exact requirement. If euro-dollar contract, you have to go 1 million or sell 1 million euro-dollar contracts. If you want to hedge about 45 million, you have to buy 45 million. That contract, and the maturity also may be different, because now contract maturities are different to the timing of your cash flows. So these are standard. But in a forward contract, it is much more comfortable, where you can have a tailor-made contract, but only thing you have to identify a party and have a tailor-made contract which suits your requirement. It suits your requirement. So that is the advantage. From a bank's point of view, let's say you want to hedge a particular position, interest rate risk position, in 2 months' time. So if you can find a party, but only thing is you have to find parties yourself or through a broker, because there are a lot of brokers in the market. They will find a matching party to you, right? So then you can hedge your position the manner in which you exactly want. If you can find a partner, okay, 2 months' time, want to take the opposite position, that's advantage. So it's tailor-made, customized. So what is the disadvantage? What is the disadvantage, main disadvantage? Anybody? Any ideas? What is the possible disadvantage?
For the forward contract, there will be a default if not doing the contract on that particular day because there's no underlying assets are involved in it, or there's no security or any margins are involved.
Okay, you are exactly right. The default risk. Because this is an agreement between two parties. There is no underlying security behind it. You see? Suddenly, the other party feels that I should not honor the contract because I am at a disadvantage, he may quit. Of course, there are contract terms, legal agreements may be there, but only thing is no point in fighting in a court of law, whatever, if you couldn't manage your risk properly. Okay? So that's, I mean, there may be underlying contract legal, but which is not useful from a risk management perspective. So the default risk is there because there is no, that's not a standardized contract traded in a standardized exchange. Other party can easily default. Then there is no way to, mitigate your risk if the other party defaults, right? So that is a disadvantage. But in a standardized contract, as she said, of course, this is in the contract, there are margin requirements, all those are there, so you are protected. Okay, so let's look at an example, okay, how we can use a forward contract. Now, an investment company holds a 6-year bond with 8% coupon, 8% yield, and a face value of 1,000 amounting to rupees 500,000. So a company holds 6-year bond. Let's say investment bank holds a 6-year bond with 8% coupon, 8% yield, and a face value of 1,000 amounting to 500,000. Okay, so basically, maybe how many? About 500 bonds. They are holding about 500 bonds to the value of 500,000. Company intends to sell this entire bonds in 3 months' time in order to settle a maturing debenture issued by the company with a similar value. Okay, so the current value is 500,000, and company plans to sell it in 3 months' time in order to settle a maturing debenture issued by the company with a similar value. So that means there is a debenture issued by the company maturing in 3 months' time, amounting to 500,000. So what is the plan for the company is to sell this bond and settle that debenture. As per the monetary policy announcement of the central bank, policy rates are expected to increase from current level of 6% to 8%. Okay, so the policy rates, which are at currently 6%, are expected to increase to around 8% over the 3 months in order to curb the rising inflation. Now, describe the risk in this instance and how you are going to manage it using forward contracts. So you are the risk manager. Now, what is the risk? And as a risk manager, how you are going to using, how you are going to manage it using forward contracts. What is the risk? What is the risk? Now, this is the important factor. As a risk manager, what is the possible risk? Possible risk. Can someone tell possible risk?
Bond price will fall.
Yeah. How due to what?
because of the interest rate is going up, trend is going
When
up
you,
because of the.
yeah, okay. So always when you say risk, express in terms of the item first. Yeah, now here we are talking about interest rate risk. Okay, then interest rate means the possible risk is the rising interest rate. So always express the risk in terms of the potential risk element. If you talk about foreign exchange risk, the interest, the risk is appreciation of the foreign exchange, whatever dollar or rupee or whatever, or depreciation. So always use the right terminology. So that is the thing. That is the risk arising from the market factor. The risk is interest rate rise, as a result price drops, right? Okay. So interest rate, the risk to the bank is possible interest rate increase, possible interest rate increase. If that happens, value of these bonds will fall. So then what happened? Because your liability, whatever the market value effect, you have to pay the total liability, isn't it? Okay, you have to pay the total liability. So the amount available to settle the liability will be less than, because of a value falls. You don't have 500,000, probably you have end up with 450,000, which we don't know. This happens. Now, there is a certainty now. Why? There's a message saying 6 to 8% in the policy rate. So if the policy rates go up by 2%, naturally assume at least by 2% in the market. So the current yield is 8%. So the yields are expected to rise to around 10%, right? Then this drop could happen, okay? So that is the risk view. So that now identify the risk. Now how we are going to use it, manage it using the forward curve. So that is the second part. Can you identify the risk? Possible rise in interest rate in the market by around, let's say, 2%, 6 to 8% policy rate means market rates will go up 2%. As a result, the value of bonds will fall below 500,000. As a result, you will not have sufficient funds to settle your debenture. Now, how do you manage it using the forward contracts? Tell me. Now you are the risk manager. So here we are talking about a micro hedge. What is this micro hedge? Hedging against this bond. Micro hedge. Tell me, very easy. You know the instrument also. What you have to do? What you have to do? Very simple. I mean, this is what you have to understand. Your risk manager, this is a scenario given. What is the risk? What you have to do? You have discussed long enough on futures now. Concept same. Difference is the type of instrument. Earlier futures, now forward. Micro hedging. This is what your banks doing day to day. Forward contracts. Enough in our market. What you will do? How to identify the risk? You know the instrument. What you need to do? It's a simple thing. tell me in a perfect scenario what you can do. Perfect scenario. In a perfect scenario, what you can do. Of course, in real market, you cannot make a find a perfect match, but what you can do. This is why if you don't understand it, you can't do any risk management. You lose. Understand the principle. Anyone? At least one person can tell something. No one? There were several people in the risk area also in this group. Okay, simply you have to short a forward contract. Where you end up with getting this 500,000. So you short a forward contract with a similar yield and similar yield that can be match the contract, the relevant date, 3 months time. Short 3 months forward contract. Okay, it's pretty simple. I mean, it's not magic. Earlier you short futures, now you short forward. So what happens? Okay. Now price of the bond today is 1,000. I am referring to face value. Expected yield in the bonds in 3 months time, 10%. Remember? So if the market yield is now 8%, now if the policy rate goes up from 6 to 8, so we expect the bond rate also will increase by 2. This is a perfect scenario. I'm referring to perfect scenario. So what is the price of the bond in 3 months time? 912.89. Everybody agree? How did you get 912.89? How did you get 912? Can someone tell? Can someone work out price in 3 months time? Okay, I am not going to work out, but remember last time when we did an exercise, remember this bond is a 6-year bond with 8% coupon, 8% yield. We worked out last time in a question, this bond, if the interest rate rise to 10%, remember last time first question, price will drop to 912.89. This is something we worked out last time. So that's how we got the price. The interest rate rise to 10%, the price would be around this much, right? So that means in 3 months time in the physical market, cash market, you can only sell this bond at 912.89, not at 1,000. So we have 500 such bonds because we have our value is 500,000. So each bond will be traded around this much. So our loss is 87.11, 1,000 minus this. Now, To mitigate that, I sold 3 months forwards, short, sold 3 months forward at 1,000 rupees. So what is the price? 1,000 rupees. Same bond, 6-year bond with 8% coupon, 8% yield, and a face value. Same bond. Now, this is a perfect scenario I am talking, discussing to explain the theory. But in real world, somewhat comfortable amount of this loss, right? Have you fully hedged? Have you fully hedged? Huh? Have you fully hedged? Have you fully hedged? Can you all see this or something wrong? Is it disconnected? No, no one talking. I think it's there. Have you fully hedged? Yes. Why? Now, in 3 months' time, you have already sold the forward at 1,000. You will get 1,000. You have sold. So there's a party who agreed to buy from you. Okay? So there's a party. Now you are the seller of the forward contract. There's a party who will buy from you at 1,000 that bond. At what price? 1,000. But market, what is the price that time? 912. How do you settle the contract? How do you settle? Buying the market at 912.89. So on your forward position, you end up with a gain of 87. This is a perfect match. So here you are losing on the cash market, forward market you are gaining. So your net effect is 0. You are fully hedged against possible interest rate rise of 2%. Very simple. When someone asks, okay, can I find a party with, okay, that is the question. So we have to find a party who can at least match your requirements. May not become, now this is for the explanation, but you can find a party who would like to sell 3 months forward at a whatever rate, okay, at suitable of a particular bond trading at a particular yield and a particular coupon, so that that coupon, that bond price will decline in a manner, so you will gain out of the forward contract. So in reality, what it does is, forward contracts want to ensure your final positions remains as it is. That is the risk management. Here you are not doing any speculation. That's part of risk management. Now then, let's say instead of it's moving up to 10%, interest rate dropped. It's a totally different scenario. Assume that happens. Now you forecasted interest rate rise of increase of 8 to 10%, but let's say opposite happen. It drops. Then what happens? To, let's say, 6%. Stop to 6%. What happened then? Can we hear from someone at least?
Bond price is 1098.
Then of course you are benefited from the cash market, isn't it?
Yes.
So you will get more than you need only 1,000, but you will get more than that. Then what about forward market?
Loss.
Forward market loss. So then what you do? You just simply forget about the forward settlement.
We can't, because if it's a reputation of
Yeah, so you can't because now in the cash market you are ended up with a gain. Because of that, you can't ignore the forward contract. You can't default, so you have to honor the forward contract. So you have to sell the forward contract at 1,000 rupees. But now market price is 1,098. So in the market, cash market, you end up with a gain of 98. Forward market, you end up with a loss of 98 because you sell something worth 1,098 at 1,000 rupees in the forward market. So your loss in the forward market will end up with a gain. So ultimately your position will be what? How much? How much? You end up with
0 difference.
Yeah, 0 in the sense you will realize 1,000 rupees, because you are covering yourself. Because your target is 1,000, you ended up with 1,000. So that is the benefit of forward market. I mean, it doesn't end up with either additional gain to you, additional loss to you. It will make certain this is your cash flow. This is your cash flow. But sometimes you may miss the opportunity also. Now let's say if you didn't hedge, of course, if the interest rate went up to 10%, you will end up with 87.11 loss. Unfortunately. But let's say factors were to your side and you ended up with a declining interest rate. So you ended up with selling at 1,098. So which made you to earn additional 98. So you made a profit if we didn't have any. So we can't predict, So that's why the idea of forward contract is to ensure somewhat certainty in the market. So when you are unsure, what is the best thing you can do? So a little bit unsure, 50-50. It can go up, it can come down. Then it's in such case, what do you do?
go with future contract rather than going for a
future contract also same. No point because you have to honor. What do you do? There is no difference. What do you do? What can you do? So many things you can do. We can look for an option, which we'll discuss later. We can go for a put option. But there is a premium you need to pay. So you can think about a put option. We will look at those later when we come to options. But remember, the idea of a forward is to ensure your cash flow will not be affected because you know certainty. That's the objective. Now, risk managers are not speculators. Because what you want to ensure is, okay, whatever happens in the market, when I enter into a contract, this is I am getting at the end. So I know beforehand. Now take a foreign exchange forward contract. I think all of you are very familiar with foreign exchange forward contract. Now when an importer imports certain things today and settlement will be in 3 months' time. Now what is the risk to the importer? Let's say somebody importing something from USA. So the importer has to pay dollars Let's say importer want to pay $1 million for the imports. So what is the risk to him? What is the risk to the importer? Tell me, what is the risk to the importer?
Currency depreciation.
Currency means what?
Dollar depreciation. The exchange rate depreciation, then with the we have to pay more. We have to pay more rupees to get the dollars. So the
rupee depreciation, not the dollar depreciation. Dollar appreciation and rupee depreciation, right? It's not the dollar depreciation. Depreciation of Sri Lankan rupee. Now, local importer want to. So, if the rupee depreciate, dollar appreciate, you have to pay more dollars in 3 months' time to pay your $1 million. So today, let's say dollar is 200. So you have to pay 200 million today if you want to buy. But let's say 3 months' time dollar is 205. So you have to pay 205 million rupees. So you have to pay additional 5 million. So what he can do is he can ask for the bank to offer a forward contract. So bank will quote a price, and so they are even what it does. So bank will quote a forward rate, forward price, and tell, okay, I will sell forward dollars forward to you at, let's say, 202 rupees, let's say, with a premium. Okay. So for me as an importer, what is the advantage? I don't know. Exchange rate maybe even go down to 198. I know I have to pay only 202 million now because of the forward price. So it makes my life comfortable. So that is the objective of risk management. It makes my life comfortable. Because I know, since I have the forward, I plan my cash flow of 202 million to pay this import invoice. So that is the part of the risk management through a forward contract. Okay. So let's say market suddenly rupee fell to 195. I can't help. I can't help. Okay. I now have a forward contract. I have to order that. So think risk management not from a speculative perspective. Risk management is to ensure your cash flows take place the way you want at a predetermined level. Okay. If you are a speculator, you will take a chance. Let it go. Why should I hedge? I will take a chance. You are a speculator. But as a banker, you have to manage your risk. Okay, this is how you fully hedge, loss on spot position and gain on forward position. So you are making your position zero. Any questions so far? So any given scenario, you should be able to work out what is the risk management tool you are going to use. Okay, forward rate agreement is the next area, which again, most of your banks would commonly use for interest rate risk management for short-term purpose. So have a chat with your colleagues, different FRAs your banks have engaged in to manage short-term interest rates in a volatile market. Okay. So we will discuss in detail after a short break forward rate agreements, and then we move on to the SOPs and so on. Okay. Any questions before we stop for a break? Okay. Okay. We'll meet after the break. Okay. Thank you.
Excuse me, sir.
Yeah.
Can I ask a general question here?
Yeah. Yeah.
So since we discussed about this forward contracts,
Hmm.
will the central bank allow forward contracts again in near future?
Allow?
The central bank will allow the forward contract, because right now the banks are not doing any forward contracts.
The banks are doing many forward contracts, especially in the foreign exchange. Every bank does foreign exchange forward, very popular.
Now, with this currency situation in the country,
Huh?
at present with the currency crisis, most of the
That's
banks
up
are.
to you to decide depending on, but these are permitted transactions. But current market conditions is something, you know, that depending on your foreign currency positions, you have to take a decision, because now forward there are foreign currency issue, but now that is foreign forward exchange contract. But here the forward other contracts you can do. Interest rate forward, there is no restriction.
Okay, thank you.
Foreign exchange, of course, you may have concerns, then bank has to decide. But now if you take an interest rate forward, there are no restrictions.
Okay.
Okay. Any other questions? Okay, so let's move on to the forward rate agreements. Similar to over-the-counter futures contracts or single period swaps. Now, if you look at forward rate agreements, are somewhat similar to over-the-counter futures contract, or that means the forwards or single period swaps. It's a single period swap sort of a thing. If you look at swaps, it do have multi-period, but forward rate agreement one swap. So yeah, what happens is one party contracts with another party for a fixed rate that applies to a future period. The buyer receives a payment if market rates exceed the contract rate, but must pay the seller if the market rates fall below the contract rate. Okay, so there is a contract again between the two parties for a fixed rate, applies for a future period. Now that is again like a forward contract, but a little bit different. So buyer receives the payment if the market interest rate exceed the contract rate, but must pay the seller if the market rates fall below the contract rate, right? So for example, hedging a 6 month period that will commence in 3 months time from the contract date is called a 3 against 9 FRA, right? So definitely that's again a future period. Now you want to enter into a contract with a seller, let's say you are the buyer, seller, in 3 months time. The contract to be initiated 3 months time for a 6 months period. Okay, so that is called a 3 against 9 FA. Okay, 3 months time for a 6 month period means 3 against 9. That is, you execute the plan to execute the transaction in 3 months time. The transaction period is covered is 6 months. So altogether from today is 9 months, right? So that is called a 3 by 9 FRA. So in 3 months time, the payment is determined by comparing the contract rate to the current market rate. So when the 3 months coming original contract entering time comes, the payment is determined by comparing the contract rate to the current market rate. Now, for example, you are the buyer of the contract. Now you enter into a contract with the seller, let's say at to borrow something, borrow something at let's say 9% interest rate. Then if the market interest rate goes goes up, goes above 9%, the difference will be settled to you by the seller. But remember, the market interest rate falls, okay, you have to settle the difference to the seller. Okay, so that's how it again works, like a forward contract, normal forward contract, especially for the interest rate borrowings. So this is very important in the case of interest rate related borrowings for short term. Okay, so unlike cash deposits where the interest is paid on maturity, FRAs are discounted but by the settlement rate, and the differential is paid on the value date. So we are not going to discuss the settlement and all those stuff in detail, but if you are a trader, you know how these things in practically happens, but we want to highlight the concept. Now, for example, a bank has a commitment that requires borrowing of 10 billion from the market, cash market, in 2 months' time for a period of 3 months. So it is concerned over the possibility of an interest rate rise within the 2 months period. Now, let's say your bank want to borrow 10 billion, but not now, in 2 months' time. So you don't want to borrow now. So but your concern is what? Possible rise in interest rate. So if the interest rate rise above the current rate, then you have to pay a higher interest rate in 2 months' time. But you need this money for 3 months period. So then what you can do is you can use a hedge against the interest rate risk through a FRA of 90 days. So what you do in practice is there are brokers in the money market, brokers and dealers. So you can ask for a broker to quote a price for a 2 by 5 FRA, 2 into 5, because in 2 months' time for a 3 months period. So let's say the broker quotes a price of 8.5 to 8.45. Okay. So bank A pays the offer at 8.5% and deals with the counterparty bank B on the value date. So these are quoted in a different way. So you are the buyer, so you have to pay 8.5, right? So then bank B, now let's say you are entering with through a broker, the bank B, the value date is 2 months from the spot date. The first fixing is 2 business days prior to the value date. The maturity will be 3 months from the value date. Okay, so those are all technical terms, but basically the idea is the FRAs are very common short-term instrument to hedge against the interest rate risk for short-term purposes. Now let's say now you agree to settle the seller for this particular loan at 8.5% is the quote provided. Now let's say in 2 months' time the market interest rate is 9%. So what is the settlement value to bank A? Okay. So you can use this formula for the computation of settlement value. FRA settlement equal notional value times reference rate minus FRA rate. Okay. Now the reference rate is the current rate minus FRA rate, and times days for the loan. Let's say it's a 3 months actual days, and the basis. So basis, I think last time I mentioned, depending on your day count convention you adopt in your market, either it should be 360, 364, 365. If you look at different market, it is quite different. Divided by 1 plus reference rate into number of days of the loan divided by the day count convention. So now what is this notional? Anyone can tell about the notional? What do you mean by notional? Anyone? What is this notional? Can someone tell? Can someone tell about what is this notional?
Based on the existing
Huh?
amount, based on the existing requirement.
Yeah, notional amount. Now, in practice, you don't calculate the you don't settle the loan amount. So what you do is now to cover up the risk, either buyer or seller settle the difference among them based on the notional amount. Now let's say that if I want to borrow 10 billion, so difference is settled between the two parties for the notional amount. There won't be any physical exchange of cash, right? So that is called the notional amount of the loan. So there is no physical exchange of cash between the buyer and the seller of the FRA, but the difference is exchanged. Okay, so the reference rate is, now if you look at international markets, LIBOR, Euribor, Sri Lanka, you can use the SLIBOR, whatever the benchmark rate, you adopt. The days is the number of days of the loan is 4, calculated use the actual number of days each month, not just the calendar days, the calendar actual number of days. And basis is the day count basis applicable to money market transactions in the currency of the loan. That is, now if you look at US dollars, the money market rate is 360. If you look at euro or US dollar, 360. 365 days for GBP. I think we are following 364 now. Yeah. So we, in our context, now if you look at treasury bills, all these are quoted at money market 91, 182, 364. So that is the day count convention you need to follow. Now let's look at a very simple example. Nero company's cash flow forecast shows that it will have to borrow 2 million from Goodfellows Bank in 4 months' time. Okay. So the requirement is Nero company is to borrow from bank, this particular bank, 2 million in 4 months' time, not now. And also very short-term loan for a 3 months period. So it's the company proposed to obtain 2 million for 3 months period in 4 months' time. So the company fears that by the time the loan is taken out, interest rate will have risen, right? So that the risk company foresees. Now the company wants to borrow in 4 months' time from today. So there's a possible rise in interest rate which could result in increasing his cost of funds, the cost of borrowings. So the current interest rate is 5%, and this is offered by Helpy Bank on the required FRA. Okay, current interest rate is 5%, and this is offered by the Helpy Bank on the required FRA. What kind of FRA is needed? What is the FRA you need?
Four into 3.
4 into 3.
Four into 7.
4 into 7. Anyone else? 4 into 3, 4 into 7. 4 months time for a 3 months period, 4 by 7. Okay, so 4 by 7 FRA. Okay. Now, what are the cash flows if the interest rate has risen to 6.5% when the loan is taken out? Now that the agreed rate is 5% under the FRA, if the interest rate rise to 6.5% in 4 months' time, what are the cash flows? Okay, so let's move on to that. Now, if the interest rate rise to 6.5%, the interest on loan to be paid by Nero company, is 2 million into 6.5% at 100% over a 3 by 12, that was 3 months. I mean, very simple calculation. Okay. So that is my interest cost would be 32,500. Now, since I have entered into a FRA, the bank will pay me the difference. LP bank. What is the difference? 6.5 minus 5. So I will get 7,500 from the bank because of the FRA. That is the seller of the FRA. So my net cost to the cost of the loan is 25,000. Right? So basically through FRA, I have managed a substantial amount of additional interest rate I have to pay if I don't have entered into a forward rate agreement, right? Now look at what are the cash flows if the interest rate fallen. Now let's say interest rate fallen to 4%. Okay, now I have to pay still 5% under the FRA. If the interest rate fallen to 4%, what happened? I will borrow at cheaper now because market interest rate 4%. So I will borrow at 4% for 3 months. I have to pay interest cost of 20,000. Then I have to pay to the bank because earlier bank paid me because interest rate increased. Now I have to pay the bank the difference 4 minus 5. That is 1%. For 100 million at 1%, 5,000. So my net cost would be 25,000. So what do you see? What do you see from the FRA? What do you all see from the FRA? What has happened? Can anyone tell what has happened? What has happened?
The cost of the loan is same for the both rate. What is the cash flow? What is the outflow? Is the same.
Okay, all right. Because whatever happened in the interest rate market, I have tied my cash flow to 25,000. Whether it goes up, down, my cost would be same. So basically, I have maintained my cost at 5%. Even if the interest rate goes up, I am at 5% comfortable level. If the interest rate comes down, I am at 5%. So again, this has made my cash flow certain. I know this is how much I am going to pay on this loan. Irrespective of interest rate goes up and down. So when I enter into a FRA, I can close my eyes and sleep. I am not worried now. Somebody can, can feel that, okay, now. Always we look at the positive side and take decisions. And somebody, what I did, I should have not done FRA. If I had not this FRA, I would have ended up with only 20,000. What the hell I did? I had to pay 25,000. But they never talk this. Okay, if I didn't have FRA, if this happens, I have to pay 32,500. So isn't it better we make our cash flow? So any business, when they enter into a FRA, any bank, they enter into a FRA, they know, okay, they can the future interest rate, whether going up or down, because you know, this is what I have to pay. This is my borrowing cost, right? So that is the benefit of FRA, short-term, single period swap. Take another example of a market traded actual FRA. Now, bank or company enter into a 4x10 FRA. So that means that is in transaction to be entered in 4 months' time for a period of 6 months at a FRA rate of 3.4% for 20 million. Notional amount is 20 million. The 4-month forward period starts on the spot date and extends to the settlement date. The typically spot date is 2 business working days from trade date. That spot date and all when you in that field. 2 business days before the settlement date is the fixing date. This is the date on which the value of the reference rate is determined. For this particular FRA, the reference rate is 6 months US dollar LIBOR. If the 6 months US dollar LIBOR, suppose that 6 months LIBOR is 3.7% on the fixing date. Okay. The US money market uses 360 days basis. So if it is, since it is US, we follow 360 days, but if it is in Sri Lanka, we go by 364. On the settlement date, the borrower, the party that is long on the FRA, receives from the lender the amount what is equivalent to, remember our formula? Notional principal times reference rate minus FRA rate and so on. Notional principal is 20 million here in this case. Okay. FRA rate is 3.4. The reference rate, that is 6 months LIBOR is 3.7 into number of days divided by 360, date count contention, plus 1 plus reference rate, 0.37. And if you look at, if you take actual number of days as 186 for this particular transaction, then the cash payment would be US dollars 30,488. Borrower receives from the lender. Because the reference rate has gone above the FRA rate. So the borrower or the buyer of the FRA receives from the lender or the person who are selling the FRA. So that's how the FRA calculations in practice works when you are using reference rates. Okay, any questions? Okay, so if you don't have any questions, we'll move on to the next kind of interest rate risk related derivative, interest rate swaps. Now, if you look at swaps, are very famous these days. In the market also a lot of talk, Chinese swap, Bangladesh swap, and so on. Those are really the currency related currency swaps, right? Now, when you talk about swaps, there are 2 kinds of swaps, interest rate swaps and the currency swaps. So interest rate swap is particularly based on interest rate changes. So it is again a contractual over-the-counter agreement between two parties. Again, not like futures. Again, these are over-the-counter. Now, if you look at Chinese SOP, it is between the Chinese government and central government of Sri Lanka. So Bangladesh. So those are individual SOPs, tailor-made to suit our requirements. Agreed terms. Similarly, interest rate swap, these are over-the-counter. OTC means over-the-counter agreement between the two parties, right? So, to exchange a stream of cash flows. So, this is an extension of a what you call FRA, because FRA is a single period swap. It's a one payment of exchange. But general swap is a multi-payment, multi-period, multi-payment, multi-period. Okay, at periodic intervals. So you identified a swap agreement, certain period. Again, based on agreed upon notional value. When it comes to interest rate swap, because we don't exchange the principal, but of course, currency swap, you have a original receipt and original payment. Sorry, receipt and final payment. So in a currency swap, there is an exchange element as well. But interest rate swap, we don't. Okay, we don't. It's only a what you call the exchange of interest rate cash flow based on a notional value. Based on a notional value. Right? Now, what is a plain vanilla interest rate swap? Now, in a plain vanilla interest rate swap, one counterparty agrees to pay a sequence of fixed rate interest payment and to receive a sequence of floating rate. Okay. So, there are two types of interest rate, fixed and floating. All of you know, your banks offers both fixed and floating rates. Now, even in a loan, you quote different pays. If you go for floating rate, your interest rate is what you call 1 year treasury bill plus 3% or whatever, So that's a floating rate, interest rate change. Fixed rate, you say your 5-year term loan, your fixed rate loan is 10% per annum. Floating rate, whatever, TB plus 3, 4, whatever. So, in a plain vanilla interest rate swap, one counterparty agrees to pay a sequence of fixed rate interest payments and to receive a sequence of floating rate interest payments. So the two parties, one pay fixed, other pay floating. So that's how interest rate flows are exchanged. Now, especially the banks enter into this sort of a plain vanilla interest rate swap because of the structure of their interest rate products and possible interest rate risk. Now, for example, if your bank has granted loans, floating rate loans, what is the risk to you? Your bank has granted loans on a floating rate.
Interest rate going down.
Huh?
Interest rate reducing.
Interest rate reducing. So if you have now, usually in Sri Lanka, I don't think the deposits with floating rate, no? Usually most of your bank deposits are fixed rate, isn't it? Are there any banks offering floating rate?
Yes, sir, there are.
Huh?
There are floating rates now.
There are, okay. But most banks fixed rate. Now let's assuming a bank offers a fixed rate deposit. What are the banks offering floating rates? How it happens? For me, my banks, I have not offered any. What are the banks?
Most of times when the interest rate is increasing, in that scenario, banks offer floating rate.
Interest rate
Increasing scenario. Most of times.
deposits.
No. For the
No,
loans.
what I'm asking, are there any banks with deposits fixed to floating rate? I know loans are there. Loans are there, but deposits, I am asking whether banks offering floating rate deposits.
Loans.
That's my question. Okay. Loans, I know. Loans are there. Enough. Anybody's bank offering a floating rate deposit? No. I think most of our banks offer fixed rate deposit, isn't it? So now take a scenario, a bank with a floating rate loans and a fixed rate deposit. Now, what is the risk to the bank? What is the risk to the bank? Can I answer? What is the risk to the bank?
When the interest rate goes up, that asset fixed deposits rates, we have to pay the fixed rate, and advances we had to I mean, on the other way, if the interest rates comes down,
okay,
we have to pay the higher rate to the deposits, and as well as we receive the lower rate from the asset.
Okay, so the risk is simply reduction in interest rate, drop in market interest rate. So when if the interest rate drops, the income you get from your loans becomes lower, and still you have to pay the agreed fixed interest rate for your depositor. So your expenditure remains same. Our loan interest rate from loans will come down, so there will be a negative impact on net interest income. So that is the interest rate risk. Okay. So in such a scenario, you can easily use a plain vanilla interest rate swap. So there may be another party have a different scenario of risk again than you in the market. Okay. So what you receive is floating rate interest rate. What you pay is fixed rate interest rate. So your cash flow pattern is you receive floating rate cash flows and you have to pay fixed rate cash flows. So if you can find a party who need a floating rate and agree to pay the fixed rate. So there may be a party in the market due to the different interest rate structure of his products. He wants a floating rate from you to mitigate the risk. So what you do is floating rate cash flows you would give to the other counterparty and ask him the fixed rate. So then your risk can be covered. So that's how the cash flows works in a interest rate swap. So there are a little bit terminology. The counterparty who pay the fixed rate of interest is said to have the pay fixed side. The counterparty who receives fixed rate of the interest is called the receive fixed. Tenor of a swap is the time over which the periodic interest payments are made. Now, notional principle. Now, as I said at the beginning, now here we don't exchange any cash flow principle. But to determine the interest rate flows, we have to agree on a notional principle which we are going to hedge. So we have to determine now, let's say I am going to borrow certain amount which may be subject to the interest rate risk. Then what I will do is I agree with the other party to exchange interest rate flows based on that notional principle. Okay. Assume that a swap covers a 5-year period and involves annual payments on a 1 million principal amount. So basically principal amount is 1 million agreed. So the both parties agree and the exchange of interest rate flows are based on that. So if the party A is the pay fixed party and party B receive fixed party, then what happens? Party A pay the fixed interest rate cash flows to the B, and B pays floating rate interest rate to the party A. Right? So that's how interest rate swap works. Now this is very typical when you deal in especially when you want to borrow in other currencies than your own currency. Okay. And when you know certain parties who need to borrow in your market as well as you want to borrow in their market. Okay. Now take an example. Now this can be applied to even any country, any bank, any institution. Example of two financial institutions, one in the US and one in Europe. Now let's say a US financial institution with liabilities more rate sensitive than assets is affected adversely by rising interest rate. Now if you take a US financial institution, now take your financial institution, your bank, you have more rate sensitive liabilities than asset, so you are subject to interest rate rise, which will affect adversely. Okay, now take another financial institution, European, who has access to long-term fixed rate funds but makes floating rate loans. Now that European financial institution has fixed rate funds receive but makes floating rate loans, has the opposite exposure as compared to the US institution. Now their exposure is different. They have fixed rate assets, liabilities and floating rate loans. Okay. And also opposite, they are more asset sensitive. Okay. So any interest rate drop, they will affect. Because they have floating rate loans and fixed rate liabilities. Interest rate drop, they are at a different. Now, earlier case, interest rate rise, they are at a disadvantage. So they have two difficult interest rate scenarios. I mean, two different interest rate scenarios. Now, take these two banks get together and structure a swap. Now US financial institution has deposits from borrowers, short term, and pay interest on deposits, and have lend fixed rate loans and receive fixed rate interest payment long term, because that they have a negative repricing gap. They are more liability sensitive. So when the interest rate rise, what happened? Interest rates they are adversely affected. Okay. Then we have European financial institution. I go to the bottom part first. Different structure. Now they have floating rate loans and fixed rate deposits. So they are subject to opposite risk, that is interest rate decline. Okay, right. So these two institutions can, so the the US financial institution has a risk of interest rate rising. The European financial institution has a risk of interest rate decline because of different interest rate structures. So what you can do is, okay, you can enter into a swap. Now the US financial institution receive fixed rate coupon from the loan. So what it can do is, okay, I'll give my fixed rate loan interest payment to you. Okay. You give me floating rate, because if I get floating rate, I am fine. I can adjust my short-term deposit payment. So US financial institution give fixed rate to the European financial institution and receive floating interest rate payment. So whatever happened in the market, I am benefited. Benefit in the sense I am not much exposed to interest rate risk. So this can be done within local context between two banks, having different scenarios within Bank A and Bank B. Okay. Again, between a Sri Lankan bank, okay, if you have exposure between another borrowing party overseas through a somewhat comfortable swap arrangement. Okay. Now this happens in, especially in the currency borrowings by even the certain borrowers. Now when certain borrowers in the domestic market borrow from international agencies, how they manage the, not really the interest rate risk, currency risk is through a currency swap. But here only the interest rate swap, interest rate element. So we are not talking about currency rate. So exchange rate part is not covered here. Right? Now let's look at how the parties get the benefit. Now let's say if the interest rate increase in the US and foreign institution negotiate a swap, the US institution get higher interest payment as rates rise to help offset the increased cost of fund. Okay. If the interest rate decline, the foreign institution if the interest rate decline, then the foreign institution makes lower interest payment to the US, which helps offset the lower interest payment to the European institution receives on loans, right? Because interest rate rise, what happened? He will get higher interest cash flows because of what? Floating rate, and gives fixed rate. Right? If the interest rate drops, what happens? Drops, it will pay lower interest rate. Anyway, interest rate lowering will not be a problem, but it gets fixed rate payments so that the European financial institution will cover up its position. So it works for the best of both institutions. So the both institutions limit the potential benefits they might receive if rates moved in their favor. Hedge. So the US bank foregoes the potential benefits from the rate declines. European bank foregoes any potential benefits from rate increase. So the different kind of swaps are possible which carry in the degree to which they cover the interest exposure and allow institution to capture benefits if rates move in their favor. Okay. So both benefit through the cash flow. Sorry, the swap. Okay. So let's look at an example of a basic swap to hedge aggregate balance sheet risk of loss from rising interest rate. Now, this example to hedge against the rising interest rate for the entire balance sheet using a basic swap to hedge aggregate balance sheet risk of loss from rising interest rate. Now, assume a scenario. You have given fixed rate loans at 7% and you have raised deposits of 3 months LIBOR. Minus 25%, minus 0.25 basis point. Right? So you receive fixed rate of 7% from your loans. You have to pay your deposits at 3 months LIBOR minus 0.25%. Now, what is the risk to you? What is the risk to you? Anybody? What is the risk to you under this scenario? I mean, you are the risk manager. Now you have to identify the risk. Without identifying the risk, you can't do anything.
If the interest rate increase,
Yeah, interest rate increase, what happens? Okay.
the LIBOR rate will goes up, then deposit rate we have to pay a higher amount.
Exactly. I think all the others have to talk, only one student talking. Others, either not in the lecture, don't understand anything. So when you see a scenario, you have to identify the potential risks. These are not magic. Either interest rate go up, come down, depending on a scenario, you will expose to risk. That's it. Nothing else. These are very basic things. Finance and risk management are not big deals, compared to what you do in the mathematics. So interest rate rise. If the interest rate rise, as she said, what's your name, Miss?
Kasturi.
Huh?
Kasturi.
Kasturi, okay. As Kasturi said, interest rate rise, you have to pay higher payment to your depositors because your depositors' interest rate is based on 3 months LIBOR minus 25 basis 0.25%. That is 25 basis point. So the LIBOR rate goes up. Then what happened? Your spread will come down because you get a fixed rate of 7% and you have to pay LIBOR minus 0.25 for depositor. So what sort of a strategy would be good? Now you identify the risk, what sort of a strategy would be good for you to manage? What sort of a strategy would be good for you? Now you have to structure. Now identify the risk. Now you have to structure a swap now. Interest rate swap. How you should structure a swap when you have such a scenario? Now you have identified the risk. How do you structure a swap? If you can find a party, swap counterparty who can give you LIBOR related interest rate cash flow, LIBOR related 3 months, LIBOR related interest rate cash flow, you are comfortable because you receive LIBOR, 3 months LIBOR, and you pay LIBOR. And you agree to that part to pay a fixed interest rate because you receive fixed, right? So you identify a swap counterparty or swap broker and say, okay, I will give you a fixed rate cash flow based on the notional principle. You give me LIBOR, 3 months LIBOR. Then I'm not worried now. Then 3 months LIBOR, whatever, I will get that from my counterparty. And I will give him a fixed rate because my cash inflows are fixed, which I give to the counterparty, and my cash outflows are variable, which I receive from the counterparty. Swap market is one of billions market everywhere in the world. Because only thing is you have to find out a counterparty. Even in your bank, this is one of the popular, swaps are popular market. So think now, this is just a one example. You can structure many scenarios. Don't go by alone this. Now, this is a one scenario I have shown. But there may be number of substructures you can build. Don't think when I show this is the only way you can structure. This is just a one example. Now, assuming I go to a swap counterparty and tell him, okay, I will give you 4.19 fixed rate for this particular period of the swap. You pay me 3 months LIBOR. So am I worried now about LIBOR? Change. Now let's say LIBOR goes up to 10%. Am I worried now? Am I worried now? Now let's say if LIBOR goes to 10%, what is going to happen? Tell me before that. If the LIBOR rate, 3 months LIBOR rate goes to 10%, what is going to happen to me? From let's say current level of 6%, before I move on to this exercise, I want to just ask you. Let's say the current LIBOR rate is 3%. Okay, current LIBOR rate is 3%. Let's say LIBOR rate goes up to 8%. What's going to happen? Don't look at this, but just a general example. Current LIBOR rate is, let's say, okay, don't take 3%, 5%. Current LIBOR rate is 5%. And LIBOR rate will increase to 8%. What would be the impact? Current LIBOR rate is 5%. It will increase to 8%. What would be the impact for me? And someone said, these are not magic, basic things. Bankers, you have to come quickly. The current LIBOR rate, 3 months LIBOR rate is 5%. And if the LIBOR rate goes up to 8%, what is the impact on me? Can someone tell? I'm very basic, simple example I ask. Don't worry about software, anything, very simple example. Under this structure, forget about this SOP. Under this structure, what would be the impact? But if you don't understand this basic, I don't think none of you can do a SOP arrangement. Very basic, your bank's basic thing, you are in a current scenario, this is the scenario and this is going to be the impact. So you have to understand the problem and find the solution. At least one person can tell something.
If you say interest rates are going up, if we having a floating loans,
Miss, I gave a clear position. If the current interest 3 months LIBOR is 5%, and if the 3 months LIBOR goes up to 8%, what is happening? I am giving a scenario and asking. Very simple, basic question. If the current 3 months LIBOR is 5%, and if the 3 months LIBOR goes up to 8%, what would be the impact on your bank? Very basic thing. I don't know whether you are in the class or you are doing something else. If you are in the class, I think at least one of you should be able to answer this. Very basic thing I'm asking. Because if you don't know even this thing, I don't think none of you can do a even simple question on this. Very basic thing. We are not talking about very complex, Very simple. I don't know why you can't give an answer. Now, if your current 3 months LIBOR is 5%, how much you are going to pay your depositors? 5 minus 0.25, 4.75. You receive 7. So that means your spread is 2.25%, right? 2.2. If the interest rate 3 months LIBOR move to 8%, you have to pay 7.75. And your interest received is 7%. So you have a negative spread of 0.75. Earlier you had a positive spread of 2.25%, will end up with a negative spread of 0.75%. Pretty simple thing I ask. If you are a bank and you can't answer, I don't know where our banking is moving. What is the direction of our bankers? Pretty simple thing. So that's why I'm telling you all, when you learn any course, don't learn for your promotion. I'm very serious. So you have to be practical bankers, have thinking, analytical ability. That is the banker's job. Just giving somebody giving a 3-month loan, that's not a big deal. Anybody can do it. But think logically. What is going to happen? What would be the impact? How am I going to find a strategy? That is what bankers should do. Don't just learn. Even in other area, credit risk, okay, how do I look at this customer? Am I to give this loan? What are the risks? How am I going to cover the risk? Now today, what has happened? Simply, why do you cover the risk? Ask them to forward the, what do you call, property. Is that the way, you are covering your risk? No. Very simple in Sri Lankan context. Okay, you want 10 million, give me a property. Very easy. That way, if you do banking, anybody can safeguard it. That's not the way. You have to analyze cash flows and find real ability. That is what is happening in our industry. Okay. So what do you want is something beyond that. That is the purpose of your learning. That is the purpose of these programs. How do you see a scenario? How do you analyze a scenario? How do you find solution for a scenario? We can just come and tell you something, and that's not the way. You have to be, you are the real practical people in the business, not us. Okay. Our banking 100% are collateralized lending. Most. No. Very rarely you go by cash flow. Because you don't do risk analysis. You don't buy the rating, you don't go by other factors. Okay, I will give you 100 million, give me 120 million worth property. Fantastic. Anybody can do it. So why you are not looking at the risk perspective? What is the credit score of this man? What could change the credit score? What is the rating? What factors could lead to deterioration? What market condition which could affect his business and repayment ability? So what precautions I should take? So that's how you should look at a scenario. Risk perspective. Credit, market, anything. Okay. So pretty simple thing. So my risk is if the current LIBOR rate is 5% and if it goes up to 8%, a positive spread of 2.5%, 2.25% will end up with a negative. So that is my risk. That is my risk. So that's why I enter into a swap agreement. Okay, you give my 3 months LIBOR. So then I get the 3 months LIBOR from him. Even if go to 10%, I am not worried by it because he is giving me 10%. He has already agreed. Against which I give you 4.919. So that's the principle. So that's the structure. Okay. So let's move on to few scenarios. The current interest rate constant, LIBOR is 3%. So from loans, I get 7%. For my deposits, I pay 2.75 because 3 minus 0.25. In Sri Lankan context, you can use, I think, what is the rate you are using is, now SLIBO is there or not? Are you using SLIBO? Is it there? I can't remember the talk of a discontinuation. Still, are you following SLIBO rates? Sri Lankan interbank offer rate? Or what is the usual rate you follow in your deposit products?
This is FTP rates and
Huh?
FTP rates are offered, no, sir.
What is that?
Not fund transfer pricing rates.
No, what I mean, loan no deposits, what is the rate you are using? Let's say floating rate loans, what is the rate you are using? Is it what benchmark?
For loans, we actually use the AWPLR.
AWPLR, okay. So use AWPLR as the benchmark, okay. Maybe some banks may be using treasury bill rate, whatever. So basically, you have to hedge against that particular rate in your swap. Okay. So let's say two banks get together, let's say Hatton National Bank and Commercial Bank. The one bank is exposed to the floating rate scenario like here. So let's say, as this gentleman said, your AWPLR plus maybe 2% or whatever. Then you ask the other bank to give me the AW, because the AWPLR is fixed rate set by the, calculated by central bank, AWPLR based on your rates. So it is fixed. So then whether AWPLR go up or down, you will get the AWPLR prevailing at that time, right? So you have to structure that way. Now, LIBOR is a London interbank, many countries, benchmark, but I think in our context, I have not seen the floating rate. Now, debentures, I think you are using floating rate, no? Debentures, some banks, when they use debentures, they use floating rate. I saw research. Any bank has issued debentures? Any bank, any of your banks? I saw a couple of banks raise debentures. I have seen they are using floating rates as well. Okay, whatever. So you decide the relevant benchmark floating rate scenario. Maybe SLIBO, AWPLR, maybe cold money rate, whatever you see, maybe because treasury bill, 1 year treasury bill rate, that depends. You can decide, okay? So now you will get a spread of 4.25. Let's say LIBOR falls. LIBOR falls, we are benefited anyway, because your interest cost is 1.75 now, because 1% drop. So you will end up with a positive balance sheet impact of cash flow 5.25. And rates rises, you end up with a negative 1% impact of 3.25. On the swap clause, now this is your balance sheet cash position, this part, your balance sheet. Now you have entered into this software swap. I mean, this is not a, now remember sometimes, you will think this is the only way you can do. I have given one example. So many ways you can do. Remember, when you now, if in an exam, if I ask you to structure a swap, if there are 10 students, they will come up with 10 answers. Don't ask the other colleague, what did you do? Oh my God, I have made, so it's not like that. As far as you get the right thing. Don't get confused after the exam, how did you structure the swap? I did the floating rate this much. Oh my God, I didn't do that way. Don't worry, because 10 may come up with 10 answers. Okay. But finally, if it is really sort of a risk management answer, but there may be a person who has done wrong thing which may not manage it. But so don't think this is the only way. So don't get confused. So let's say this scenario, so a bank give a 4.19 fix and receive 3 months LIBOR. Let's say this is, I will take our colleague's example, AWPLR. So AWPLR receives, the bank pays to the depositor AWPLR minus 0.25. The soft clause are fixed rate 4.19, negative because I have to give. I receive 3% because LIBOR is 3%. So on the swap, I am losing 1.19. So my margin will be 3.06. Because swap flow, I have to give this thing. So now interest rate, okay, LIBOR goes down. I will receive 2 because I will receive LIBOR. And I have to pay fixed because fixed is fixed. I can't change. LIBOR will change. So if then I will end up with a negative 2.19. But my overall impact would be 3.06 margin. Then if the interest rate, LIBOR rate rises by 100 basis points, then what happened? I will receive 4%. I will give 4.9. I have a 0.19 spread there, negative spread. And so my final spread will be 3.06. Right? So now, as a result of the swap, I have maintained my margin at a comfortable level. You know, it is because I am certain now. I am certain whatever happened in the LIBOR rate, now you see, even LIBOR 3% remain same, my net margin would be this. If LIBOR even goes down, my net margin would be this. Even LIBOR went up, my net margin would be this. So I am comfortable. I know I will end up with a net margin of 3.0. Even LIBOR went up to 5%, 6%, 7%, I am not worried. 8%, I am not worried. Now you see the previous example, if LIBOR goes up to 8%, if I don't have this swap, how much I am losing? Negative point, how much? Negative 0.75, you see. So now I am comfortable. So that's how an interest rate swap works. Right? Any questions? What I want to tell you is understand the problem. What is good? So this is what you have to do. You are the risk managers. Think about, okay, this is my position. What will have an adverse impact on me? What will have adverse impact on me? And what instrument? What is the right instrument I should use? So when I say right instrument, with the maximum utilization of your resources based on the scenario. And how do you structure it? How do you structure? That's very important as bankers. Okay. So we'll move on to the next slide. So what is a Softband? Now, a Softband is a generic term used to describe a financial instrument that facilitate swaps between counterparties. Now, there are Softbanks, but in our context, there are swap brokers. Okay, so the Softbank can serve as either broker or a dealer. Okay, as a broker, the Softbank matches counterparties, but does not assume any of the risk. Now, it can perform dual role. It can act as a broker so that you will find the parties. You will match the parties. Now, let's say I have a particular exposure in my bank to cover up. So I will go to a broker and tell, okay, I need a party which meets these requirements. Then similarly, he gets from other parties, ask him to find a party matching their requirement. So broker will find a party which suits both of our requirements, my bank and your bank. And he will charge a fee, brokerage fee. Now dealer is opposite. Now dealer is, we are not going to have a broker. Directly one bank entered with another bank, a direct swap. So the opposite bank will act as the counterparty. So it's a direct transaction between the two banks. The brokerage is something who find a party, another bank, to match the requirement. So it could be a dealer directly, or it could be a dealer, or it could act as a direct swap bank. Now, swap banks will tailor the terms of the interest rate and currency swaps to customers' needs. So they also make a market in plain vanilla swaps and provide quotes for these. Since the swap banks are dealers for these swaps, there's a bid-ask spread. Now, this is generally, these are not the current rates, but sort of how the swaps are quoted in different currencies in the market. These are not current, but euro with the NAS against the US dollar, US dollar LIBORs, sterling, Swiss franc, US dollar, what are the bid and spread? So if you are 1 year swap, how you are quoted, 2 years swap, 3 years swap, Okay, these are general conventions. So based on the swap brokerage price, you know how much you have to pay and how much you receive. Okay. Now, for example, this to take euro 10-year rate, 3.2585 means the Softbank will pay fixed rate euro payments at 3.82 against receiving euro LIBOR, or it will receive fixed rate euro payments at 3.85 against paying euro LIBOR. Okay. So either it pays euro LIBOR at euro fixed rate at 3.82 against receiving euro LIBOR, or it received fixed rate euro, okay, at 3.85 against payment of euro LIBOR. So depending on the rates, the different currencies, this is when it comes to different borrowings from different currencies, right? So the swaps could be either work out for different borrowing scenario in terms of different currencies as well as within your own currency, right? So now let's look at the structure. The 3.8 to 2.85 means Softbank will pay a fixed rate euro payment at 3.82, receive 3.85, and pay LIBOR to firm B and receive from firm A LIBOR. Receive fixed 3.85, pay fixed 3.82, receive LIBOR and pay LIBOR. Now let's take an example of two firms who want to borrow 40 million for 3 years, dollars 40 million, or rupee, whatever, 40 million. Okay. Now this is again another way of, borrowing. When the different institutions want to borrow in the market, the different interest rate scenarios apply for different firms. It's not the same, no. You will not charge the same interest rate from your customers. Depending on the risk rating, you will charge different interest rate. You don't charge a common interest rate for everybody. Knows that's why you have a average weighted prime lending rate, AWPLR, and other rate, and so on. Now take an example. Two companies having a scenario like this. If they want to borrow in the fixed rate market, they can borrow at 5%. And if they want to borrow in the LIBOR rate market, they can borrow, if they want to borrow in the floating rate market, they can borrow in the LIBOR. Let's say firm B, if they want to borrow in the fixed rate market, they need to pay 5.5. LIBOR market, they need to pay LIBOR plus 0.2. Now, firm A wants to finance an interest-sensitive asset and therefore wants to borrow at a floating rate. Okay. Now, firm may want to finance an interest rate sensitive asset. Okay. So, rate sensitive asset. So, they want to borrow in a floating rate market. Floating interest rate at a floating rate. A has good credit and can borrow at LIBOR. Now, firm B wants to finance an interest rate insensitive asset and therefore want to borrow at a fixed rate. Now, the asset is not interest rate sensitive, so fixed asset, so he want to borrow at a fixed rate. So the B has less than perfect credit and can borrow at 5.5%. Okay. So what does it mean? if A go to the market, A has to pay, because A has to borrow in LIBOR rate, and B want to borrow fixed, B need to pay 5.5%. Right? Now both have a comparative advantage in each market. Now what do you observe? Which market each firm has a comparative now? B is a higher risk company. Anyway, B has to pay higher amount, higher interest rate when it borrow. But it has a competitive advantage in one market. A has a competitive advantage in one market. Comparative advantage. So which company has a comparative advantage in fixed rate market, which has a comparative advantage in LIBOR rate market? The Softband quotes 5.1 to 5.2 against dollar LIBOR for a 3-year swap. So there is a Softband which can offer 5.1 and 5.2 against dollar LIBOR for a 3-year swap. So which bank has a comparative advantage in fixed rate market? Which bank has a comparative advantage in floating rate market? Tell me. Anyone can make a guess? Of course, A has a comparative advantage in fixed rate market because spread is higher. B has a comparative advantage in LIBOR market because spread is lower compared to the fixed rate market. But A need to borrow in LIBOR market, B need to borrow in fixed rate market. But B has a comparative advantage in LIBOR market. Now, firm A pays bank X 5% because it need to borrow in fixed rate market. Okay. And takes up the Softband on their offer 5.1 and 5.2. They can convert their fixed rate 5% debt into floating rate LIBOR minus 0.1. Now, what Softband what firm A can do, okay. Firm A borrows from the bank at 5% because fixed rate they can buy at 5%. And they enter into a swap deal with Softband. Now, Softband has quoted 5.1% against 5.2% for a 3-year swap. Okay. Enter into a swap. The Softband for 5.1% and receive fixed and decide to pay LIBOR to Softband, right? So my final cost would be in a such a scenario 5.1% minus 5.1 I am making again, and I get a 0.1%, my final cost would be LIBOR minus 0.1%, right? Now let me move on to the bank B. Okay. Sorry, firm B. Firm B, I can borrow at LIBOR plus 0.2 and take up the swap of 5.1, 5.2 and convert their debt, floating rate debt into fixed rate debt at 5.4%. Okay, so I will borrow from bank Y at LIBOR plus 0.2%. I will go to the sub bank and sub bank will give me LIBOR and I will give him 5.2%. So my cost would be LIBOR, I pay LIBOR minus LIBOR plus 0.2%. Okay. So I pay minus LIBOR plus 2%. And pays 5.2. So my final cost would be 5.4%. Okay. So final cost is my LIBOR plus 0.2% plus 5.2% minus LIBOR, that is 5.4%. Now what did you see? So what's the structure for the SoftBank? Now SoftBank makes a 10 basis point on the deal. It gives firm A 5.1, receives LIBOR and pays that LIBOR to firm B and received 5.2. So SoftBank make a profit of 10 basis point. 10 basis point. Right. Then whole structure, if you look at, this is the whole structure. The loan amount is, let's say, 40 million. I think that's what we discussed. Earlier. Yeah, 40 million for 3 years. So annual change, saving $40 million for 3 years. A earns 40,000 per year on the SOP because he saves 0.1%. B earns 40,000 per year on the SOP. SOP banks earn 40,000 per year on the SOP, right? How? Because each now firm may reduce the LIBOR rate by 1.1%. Firm reduce fixed cost by 0.1%, and sub bank earn 0.1%, right? Right? Clear? So every party benefited from this swap transaction. Any questions? So A has transformed a fixed rate liability into a floater, LIBOR minus 0.1%. Firm B has transferred the floating rate liability into fixed rate liability at 5.4%, a saving of 10 basis points. That's how this 40,000 comes. Any questions from that? Any questions? Anything you need to clarify? No? Okay. So let's move on to the next slide. So what about the principal? In our plain vanilla interest, only interest rate swap just given. We did not mention any swapping of the notional principal. So we didn't discuss about swapping of the notional principal. It could be the case that firm A exchange principal with their lender, Bank X, and firm B exchange principal with the outside lender, Bank B. So there is no exchange between firm A and firm B. So simply they entered to a swap through a swap bank. So that is the benefit of interest rate swap. So let's look at the cash flows. At time 0, firm may borrow from bank B 40 million. Firm B follow 40 million. Okay. Then assume a LIBOR rate of 3%. Assume a LIBOR rate of 3% at time T1 after 1 year. So how the structures work? If the LIBOR is 3%, I have to pay. Firm may pay Bank X how much? Firm may pay Bank X how much? $5%. Is that right? 5%? You have to go back. 5%. And pay LIBOR and receive 5.1. Firm B pay bank Y LIBOR plus 0.2%. So 5% of 40 million, 2 million. And pays LIBOR. What is the LIBOR rate? 3% on 40 million, 1.2 million. Receives 5.1%. 1%. Okay. So receives 2,040,000. Based on 40 million principal, if the LIBOR is 3%, they will pay, firm B pay the bank X 1.28, LIBOR plus 0.2%. Receives this LIBOR and pays 5.2%. So what is the net cash flow? Softbank receives 1.2 million, pays 1.2, no cash flow, 0. Receives 2.08 and pays 2.04, 40,000 per year. Bank company A receives 2,040. Okay. Pays Softbank 1.2. Okay, so receives 2.04. sorry, 2.04 pays on the loan, how much? 2 million. Relative to borrowing at LIBOR at 3%. Okay. So it saves 40,000. Right. And company B saves another 40,000. Right. Because if enter into a SOP, which I mentioned earlier, saving of 10 basis points. So similarly, you can structure for the next year, time to, let's say LIBOR is 4%. And after 3 years, LIBOR is 5%. So whatever the structure, what happened? You end up with same. Okay. You went 4%, second year, you end up with same saving. Right? Even 5%, you end up with same saving. So what does it mean? Irrespective of the interest rate movements, we are comfortable, right? We are comfortable with our cash flows. Okay. Give me a second, I want to fix this. Okay. So we are comfortable because even the interest rate at 3% after 1 year, LIBOR 4%, LIBOR 5%, our position is very clear. So my benefit is 40,000 because of this SOP. So my cost for, that is firm A, my cost would be LIBOR minus 0.1%. If I didn't enter a SOP, how much I have to pay? How much I have to pay? LIBOR plus 0.2. So I save 0.1% of 40 million, that is 40,000. Now, even in company B, I need to borrow in fixed rate market, so I have to pay 5.5, but I paid only 5.4 because of SOP. If I didn't have SOP, I have to pay 5.5. So both firms benefited and also Softbank benefited. So my cost saving would be 40,000. Any questions? So, this is again another question. Now, you can work out at home. We can discuss next week. Now, firm A can borrow in the fixed rate market at 12% and floating rate market at LIBOR plus 0.5%. Firm B, probably a higher risk company, can borrow at 14% in the fixed rate market, can borrow in the floating rate market at LIBOR plus 1.7%. Okay. So differential is 2% and 1.2%. Net differential is about 0.8%. How firm A and firm B can get together and work out interest rate swap to minimize the interest rate risk and get the comparative advantage benefit. Can you all think about a structure we will discuss? There may be many more answers, but not only one, but both should benefit. You should structure in a manner both should benefit. Right? Any questions? Okay. So these are the scenario analysis you can think of depending on your interest rate environment and structure of interest rate. It may be different from one bank to another bank. One bank want to safeguard again interest rate because of the floating rate structure. Another bank because of the fixed rate structure. So when two banks get together, they can structure a swap in such a way that both can benefit. Okay, any questions? Any more questions? Please study the impacts. That is important. Go through the notes and see the theory, but then visualize how a particular scenario take place. How do you look at the scenarios? What is going to happen? What is the risk to me? Okay. Then how I'm going to manage that? Okay. Considering many other aspects. So that is the important part from your point of view. Ability to understand the problem, look at the risk, and find solutions. Find the appropriate solution. Okay. So if you don't have any questions, we can stop for the day. So we will meet next time.